Welcome, and thank you for joining us for today's webinar entitled China 2016 Financial Industry Trends and Outlook, brought to you by Capron Asia. My name is Paul Robinson, and I'll be acting as the webinar moderator. So what lies ahead for the financial industry in China and Asia in 2016? Will digital payments, m-commerce, and industry reform dominate the headlines in 2016? Will the likes of Baidu, Alibaba, and Tencent continue their push into financial services? Or will the Chinese equity market continue to dominate headlines and impact global economies? In this informative 45-minute webinar, we'll talk about all these topics and present the findings of our upcoming Top 10 report detailing the trends in China's banking industry, as well as another Top 10 report looking at trends in China's capital markets industry. Now, I do need to inform you that today's webinar is being recorded and is running in listen-only mode. However, we really want to encourage feedback and questions from you throughout the webinar. And since we always get lots of questions, we're going to get through the presentation in approximately 30 minutes. Then we'll spend about 10 to 15 minutes in our question and answer session. So in order to facilitate that discussion, we're going to use two features of the webinar software. The first is the viewer window, which is where you see the presentation. I'd recommend you maximizing that now so you can see it in full screen. And the other way is on the control panel, is that where you can interact with us as well. Now this control panel can be opened and closed by clicking on the arrow button on the grab tab. In that control panel, you're welcome to submit the questions and comments to myself and to Zenon. We'll be answering those as we go along and as I mentioned at the conclusion of the webinar too. Now, our presenter today is Zenon Capron, Managing Director of Capron Asia. Zenon is joining us from Capron Asia's head office in Shanghai. As one of Asia's leading providers of independent research, custom consulting, and advisory services focusing on the financial industry and financial technology, Capron Asia helps clients understand and navigate the challenges they face in a region with a rapidly changing business, operational, and technological environment. Now, with all of our housekeeping out of the way, let's get the discussion started. Zenon, please go ahead.
Thanks, Paul, and welcome everybody. We're happy to have you here on the first webinar in our series for 2016. This is the sixth time that we've done our financial industry trends and outlook and top 10 reports. And I'd have to say that 2016 is shaping up to not be necessarily the most positive year for China in general, but definitely one of the most exciting. What we want to touch on today and kind of walk you through a little bit in this webinar is some of the themes that we're seeing going into 2015. And Paul hinted at some of those. I mean, if you look at what's happened over the past couple of years, you've seen private banks come to the market. The stock market over the past year is a big story in China. The Hong Kong Shanghai Connect, the push that Baidu, Alibaba, and Tencent are having internationally. There's so many things to talk about in the financial industry. And to be honest, I mean, that was one of the challenges that we had putting together the report this year, is just that there's so much to talk about. So what we're hoping to do today in this half hour of presentation and a couple minutes for Q&A is give you some of the themes that we're seeing. And these aren't by any means exhaustive. There's a lot to talk about in China right now, but what we see as being some of the key drivers over the next year. So before we get into the financial industry trends itself, it's useful to look at what's happening overall with China and the economy. And clearly, when we look at China, we think about GDP growth. And GDP growth over the past couple of years, we've gone from that double-digit growth that China had been so used to for 5 or 6 years to under 8%, and now looking like what something's going to be under 7%. And so in general, this means that the economy is a little bit struggling. If you look at what's happening in China, you don't necessarily feel it in the big cities like Shanghai and Beijing, but increasingly there's a subset of companies and people that are struggling with the new normal in China. And one of the challenges for China is that the economy and the entire country has gotten used to this really explosive GDP growth, and the entire economy and the financial industry is geared around the idea that this 7 or 8% growth will continue. And so that's really one of the challenges, is can the country as a whole adapt to a new normal of, say, 6% growth or 5% growth? And that's going to be one of the key challenges from an economic perspective as we go into as we move forward in 2016. In addition to the economic problems, we still have the systemic issues. I mean, if you look at shadow lending is increasing slower than it was in previous years and almost flattening out, but it still represents nearly 40% of GDP, which is quite worrying. I mean, that's still one of the challenges that China has. In addition, it's facing challenges with the currency. So if you look at the renminbi and if you look at what China has had to do over the past year to kind of prop up the renminbi is really dip into the foreign reserves. Just in the past 6 months, China has put 500 billion into the market to support the renminbi. So these are huge amounts of money, and although China still has somewhere north of $3 trillion in foreign reserves, this is a challenge. This is another challenge for the economy, is that the direction that China wants to go with the renminbi and with these systemic issues that it has domestically. And of course, no discussion wouldn't be complete without looking at the Shanghai market itself. If you take this diagram and you map it on what happened in 2007 and 2008, it's kind of roughly the same. I mean, we saw a run up this year of incredible market performance where the market more than doubled over the course of a year. And if you think about the significance of that, we had 2007 and 2008, we had the last bubble within the market, and then from 2008 roughly until 2013, 2014, not much was happening in China, in the market in China. So these are big changes in the market. And that's caused kind of social unrest, not unrest I would say, but issues within the market. You have this new investors that are coming to market in a predominantly retail-driven market that really aren't satisfied with what's there and really aren't satisfied with what's happening in the market. But on top of that, you have these social problems that are getting more attention through social media. One of the big things right now is pollution, not just here in Shanghai, but in Beijing. And 5-6 years ago, the government could kind of put it to the side, but with social media being so prevalent in China right now, and a lot more opening up by the government about issues like pollution, there's a lot more attention to that. And that's one of the challenges for the government, is that they have to move away from this kind of production economy that they've relied on for so long, whilst at the same time containing all these social problems and social effects that are in the background. So the real question is, where does that leave us? And I wanted to start off with the presentation with a bright sunny sky view of Shanghai. But realistically, this is what we're facing today. We're facing the tower that's there in the background is the Shanghai Tower, and now that's fully complete. But it's one of the tallest buildings in the world, and it really represents China's ambitions. China's ambitions to really be a leader, not just in the financial industry, but as a global power from a political, from an economic perspective. But it's still facing these challenges like pollution, where you can barely see across the river because of the pollution that's there. And that's, if you've been to Shanghai in the past couple of weeks, that's kind of the challenge that we have here. So that's how we're going into 2016. We have a country that has gotten somewhat used to having this economic growth that we've seen over the past decade at least, but with the challenges of a market that they don't really know how to control, with these social challenges in the background. And that'll really define what China is able to do in 2016. So when we get into a little bit more about what the government is trying to do, we look at things like this expansion. So as I mentioned, the ambitions of China, if we look at what they've done in capital markets over the past couple of years, in 2003, we first had the QFII program, which is the Qualified Foreign Institutional Investor Program. And that basically allowed foreign institutions to invest in China. That expanded in 2006 with the addition of outbound investment. And since 2006, we've seen a steady opening up of these markets in terms of the programs that are in place. So here we are in 2016, and we're looking at mutual recognition, which allows funds to be traded back and forth between China, allowing investment from both sides. We have the Hong Kong Shanghai Connect that's been in place now for just over a year. We have the RQFI program, the QDII, and QFI. So very much the government is focused on expanding the markets. In addition, beyond just the capital markets itself, we have these pushes like the One Belt, One Road. And Xi Jinping has made this a big part of his economic plan for the next couple of years by really trying to define China's footprint in the global economy. So when we look at the new development bank that's focused on BRICS, when we look at the Silk Road Fund, when we look at the Asia Infrastructure Bank, these are all China-driven efforts to make the country more relevant in global affairs and the global economy. So these things are kind of how the government's moving forward, but at the same time they're struggling, because if we look at that graph, that graph of the Shanghai markets, if we look at those ups and downs, we can also look at where the government has intervened, and it wouldn't be unfair to say meddled in the market. And so this is just over the course of 2015. We've mapped out some of the things that the government has done in response to what's happened in markets. And realistically, when you look at something like this, it shows that the government is struggling a bit. It's struggling a bit to contain kind of what's been happening and to really get on top of controlling the opening of the markets while at the same time ensuring that the risks are taken care of. And that's a constant theme, and a lot of the trends that we'll be going through today is how do they manage this? How do they manage at one point reforming the market while still controlling the market? And that's something that this chart clearly shows that they're kind of struggling with. And that's really the overall theme on all of the industry insights that we have for this year, is that the government desperately wants to reform the market, but is faced with economic and systemic conditions that won't let it or even force it to backtrack. So some of the trends that we'll look at here and some of the moves that the regulators are taking are actually backtracking on some of the reforms that we've seen over the past couple of years. And that's really the challenge going forward into 2016. So let's get into some of the trends and sub-themes that we're seeing and that we've covered in some of our reports. Now, again, these that we're going through today are not exhaustive and are just some of the trends that we've looked at, both in terms of the reports and our general research, but it should give you an idea of kind of what we're seeing as the important trends for 2016 and what some of our opinions are on this. So if we look first at the card market, I mean, one of the big trends and things that was talked about at the end of 2014 and then continued into 2015 was the opening up of the card processing and clearing market. So regulations have previously prevented foreign players or any players for that matter getting involved in the card processing market. So when we talk about that, we talk about basically the card network. So as opposed to having MasterCard, Visa, American Express in China, we just have CUP. And so CUP handles the card scheme and the card switching within the market, and then it also handles the processing in the background. And that market has been closed to any other players. But starting in 2015 and the culmination that we should likely see in 2016, new players will most certainly be allowed to launch in China for both clearing, processing, and that should be value-added services, VAS. So basically, what this is saying is that throughout the course of 2016, we will likely see the PBOC approve applications for companies like MasterCard and Visa to finally open up in Chinese markets. Previously, they'd been prevented from doing that, but obviously, as we look at the number of card transactions in China and the value of card transactions in China, it's a very juicy market for companies like that. So we'll definitely see them come into the market in 2016. But at the same time, the merchant fee is changing. So we don't have a slide on it in this presentation, but in some of our other research reports that we've done, we've looked at how the merchant fee has changed over time. And so basically in 2016, the merchant fee will consolidate and shrink. So the highest rate that a merchant could charge, or that the combined merchant fee, so basically the discount rate for a merchant, was about 1.25%, and that's coming down to under 1%. So that'll be changing. What is interesting about this is not only the fact that MasterCard and Visa may be coming into the market, but what we think is potentially more interesting is if Alipay moves into this market, if we see a domestic player move into the card processing market. Now, if you think about a player like Alipay, what they've done very successfully is driven digital payments in China. Their share of the mobile payment market is about 75%. Their share of the internet payment market is about 50%. They're starting to move offline with the plays, and they're doing this in two separate ways. They're doing this through offline acceptance and O2O transactions. to a certain extent, allowing them to set up a physical card network in China would close the circle on that, would allow them to further consolidate its hold on domestic offline transactions and also very quickly push into overseas markets. And that's one of the challenges that Alipay and Tenpay have had so far in their international push, is really getting the acceptance out there. But if you have a card brand, you can make quick agreements with either foreign card brands like a MasterCard or Visa or American Express, or you can work with the banks to increase acceptance very quickly across foreign markets, which may be one of the interesting things that happens in this card processing space. Along with what Alipay and Tenpay are doing in the payment space, we're also seeing this direct banking, and so we talked about this in our trends for 2015 as well, but what's changed since then is all three of the BAT, so the Baidu, the Alibaba, and the Tencent, have set up private banks. Baidu's banks will be set up at some point in 2016, but My Bank from Alibaba and Financial and WeBank have already been set up in 2015. Now, when we talked about this in 2015 and our trends in 2015, we really felt that this would be one of the key drivers in 2015, and this is one of the things that we were kind of wrong on. Both of these banks, My Bank and WeBank, have been set up, and they do have customers, but the customer base that we're seeing, although these numbers aren't actually reported by Ant Financial and Tencent, are much smaller than we've expected. The movement on customers moving from traditional banks to these online digital banks has been relatively limited so far. And so that's something that we feel that we're still very bullish on these banks making progress, but it may take longer than originally expected for them to make a real dent in the banking market. So we kind of expected them to be able to capture kind of 1% potentially of deposits in China, but from what it seems, they're far from that right now. But what will really change this market is their continued push into these platform services. So if you look at what Baidu, Tencent, and Alibaba are doing, they're moving from their core business, they're using big data, and they're selling these other products. And so really that's how these guys are going to differentiate against the traditional banks, is when they're able to leverage the information that they have on these platform plays that they're creating to suggest financial products and financial services. And that's how, when you look at Alipay, that's how they've been so successful with Yuebao, is that Yuebao is very tightly tied into the Alipay platform. It uses analytics on the back end to predict customer behavior, and it's able to put the right offers out there to customers in the right time. So we really see that the driver for these banks will not be just traditional banking services, but the way that they're able to integrate this into complete platform plays. In addition, this shift is going to drive digital payment adoption. I mean, we're already seeing in 2010, we were at 3% of total consumption was driven by digital payments. To 2016 will be almost 20% of all payments will be digital. So that's saying online transactions that are conducted either on the mobile platform or an internet platform, and this will continue to increase to what we see as being 27% in 2020. And this is a big change. I mean, this is moving payments away from the traditional payment providers, so the card providers or the banks just in general, to these digital platforms, so to the Alipays, to the Tenpays, and increasingly these integrated platforms that they're creating. That being said, it's heavily consolidated. So when we look, and I mentioned this before, when we look at mobile payments, when we look at internet payments, this research from iResearch shows that, in 2015, the mobile payment market has consolidated even further. So Alipay has gone from, under 75% in 2013 to almost 80% of mobile payments in 2015, and really consolidated the mobile payment market. And we're seeing on the internet payment market, it's staying roughly the same, but we're not seeing these kind of second and third tier providers really make a dent in it. And one of the things you'll notice is that the banks and the China UnionPays just aren't even on the map for these. So although digital payments is really going to be growing over the next couple of years in China, the consolidation that we're seeing is in a very few couple of players. So when we look at one of the other things that was talked about heavily in 2015 2015 was this concept of kind of online to offline and the online to offline push. And increasingly, these digital players are using not just online to offline, but completely offline acceptance. So towards the end of 2015, Alibaba launched a program on its Alipay platform that basically allowed anybody who had an Alipay wallet on their phone to receive a 300 renminbi referral fee. So this is basically saying that I could go in with my Alipay wallet on my phone, and I could sign up a merchant, and I would get, as a customer of Alipay, I would get 300 renminbi if that merchant signed up to accept Alipay payments. And this has been tremendously successful because one of the challenges in China is acquiring. But if you think about what's required to actually take a payment from Alipay for a merchant, all you need is a phone. All you need is some kind of mobile device. You don't need a point of sale terminal. You just need something on a phone or on a digital device that allows them to accept a QR code payment. And so what Alipay has done is basically taken these 300 million people that are using Alipay and put them onto this essentially national acquiring sales team to allow them to go out and to acquire merchants in that space. So basically what this is doing is creating an incredibly competitive environment, not just online, but offline as well. And now we've seen finally that Apple Pay, Samsung Pay, and Union Pay are making a push in 2016 into the mobile payment space. Apple Pay had been talked about for a long time about when it was coming into China, as was Samsung Pay, and people were wondering what was happening with China Union Pay as well, because China Union Pay obviously is the dominant provider for offline transactions, but for online transactions and mobile payments, it really wasn't there. So these three players are coming into the market in 2016. All of them are different than WeChat and WeChat Pay and Alipay insofar that they run on NFC, or near field communications. So NFC point of sale terminals basically represent now about 100% of new terminals on the market and about 40% of existing terminals on the market. So a lot of the new terminals that China Union Pay is pushing out are NFC enabled. But the question is, even with these going forward, is that going to be enough? Is that enough? Is it too little too late for these players coming into the market? And are they going to be able to make a dent? Are they going to be able to provide anything that's different than what Alipay and WeChat Pay are actually providing? And it's a bit unclear in that space. So these digital payments are one of the really hot spots in what has become essentially the Fintech China and everything that's happening within Fintech. And at the center of this is really Baidu, Alibaba, and Tencent. I mean, what they've done not just with the payments platforms, but with Fintech in general has been really good. They've developed the digital banks in place that are tied into the mobile payment platforms, and they're really pushing forward with what we believe is really some of the first digital banks globally. But outside around this, there have been a lot of innovations around financial management, peer-to-peer lending. We're seeing companies like Dianrong, PPDai, Lufax, some of the wealth management platforms that are out there, some of the other payment platforms that are out there, some of the offline connected POS players that are out there, really developing fintech in China. So we saw over the course of 2014, 2015, kind of the renaissance and the start of fintech globally, and it really hasn't taken off in China yet. But I think in 2016, we could see more around the fintech space in 2016. But there are huge challenges. Just a couple of days ago, the government basically said that there will be no new business registrations in Shanghai, Beijing, and Shenzhen for companies that have internet finance in their business registration. So in China, it's very important for any company that's doing business here to have a business description along with their business license. And so basically what the government has said, that any company that comes with a business description that includes internet finance, including wealth management, peer-to-peer lending, payments for that matter, will not be approved for setup, at least for the near future. So that is, of course, a huge challenge for a startup financial services or fintech company, and that will greatly limit what's going to happen in 2016 in fintech in China. And we've recently posted an article about this, commentary about this on our website as well that kind of covers this. So that means that Baidu, Alibaba, and Tencent, who already are set up, and the peer-to-peer lenders that are already set up, will really drive fintech going into 2016. But these players very clearly are much more in the space of copying rather than buying small fintechs. So instead of seeing these small fintech companies develop and be bought out, we'll likely see more innovation from the bat moving forward into 2016. And one of the things that hasn't been talked about much is the acquisition potentially of one of these platforms like a Tianrong or one of the other peer-to-peer lending platforms that would very quickly expand the BAT footprint in peer-to-peer lending and other wealth management products. And when we talk about peer-to-peer platforms, I mean, clearly they've been one of the success stories within fintech, as much as you consider these platforms being a success story. If you look at the growth and the development of these, I mean, we went from about 15 platforms in 2010 to, well, there were about 3,500 platforms at the beginning of 2015. Those, about 1,000 of those platforms, incredibly about a third of the market, failed. And now we're left with 2,500 peer-to-peer lending platforms in China, which is still an astonishing number. Now, a lot of this is consolidated around those big players. It's consolidated around the Lufax, the Dianrong, the Equities, the Irendai platforms. But there is a long tail of peer-to-peer lending platforms that's happening there. Now, that uptake, when you think about what these platforms are offering, the more legitimate platforms are offering a much better interest rate than deposits and what investors could get, and they're seen surprisingly as safer than the stock market as well. Even though there have been a tremendous number of failures, the return that you can get on one of these more established platforms eclipses anything that you could get from a deposit in the bank. So that's driven a lot of the growth in this. And what that's also driven is the ability for a lot of these platforms to move beyond just peer-to-peer lending. So when we look at a platform like Lufax, Gregory Gibbs, as they prepare for their listing potentially in 2016, he really wants to be the Charles Schwab of China. And so if you think about Charles Schwab is basically a brokerage in the US that has become a clearinghouse for any number of financial products. And indeed, that's what Lufax is trying to do, not just peer-to-peer lending, but become this essentially financial supermarket for consumers to go to. And so we'll see a lot more development than that in 2016. But at the same time, regulation is coming. And regulation may limit a lot of this. Just a couple of weeks ago, there was the regulation that came out from the CBRC talking about what peer-to-peer lending platforms can do. Many of them guaranteed returns. Many of them had the accounts on their own balance sheets. Many had limits on the lenders and borrowers. So basically this regulation is designed to fix a lot of the problems within the peer-to-peer lending space. I mean, we saw in that previous chart that really it was in 2010 that the peer-to-peer lenders started to take off in China, and now we're here in 2016 with 2,500 platforms. There needs to be regulations around this, and really the regulator's goal here is to reduce the risks, both in terms of fraud, systemic risk, and to increase transparency for peer-to-peer lending platforms. So those are some of the overarching themes that we're seeing in 2016. Wanted to kind of close out what we had to talk about before we went into the Q&A session with some of our key predictions for 2016 and what we see. Mobile payments, as we talked about before, will continue to grow for existing players and foreign players who struggle. We still believe that Baidu, Alibaba, and Tencent will consolidate their online footprint further in mobile payments and internet payments, but and continue to move into these offline payments and in international. And so that will really be a struggle for Alipay, Samsung Pay, and Cloud QuickPass. And we don't see them capturing more than 5% of the market in 2016. Peer-to-peer lending will consolidate heavily. I think the peer-to-peer lending regulations that we've just seen over the past couple of weeks are just the start. I believe we'll see more around that. What happened within the payment space is that we saw a lot of consolidation when payment licensing started, and peer-to-peer lending licensing is not out of the realm of possibility. So I think we'll see licensing around peer-to-peer lending in 2016, which will further consolidate the market. And mainland stock markets will continue to suffer. I think the economics of China are not particularly great. Investors have short-term memories that are a lot that were burnt by the moves of the market over the past kind of 6 months, and there's no real near-term signs of anything could jumpstart the market. So when you look at those jumps in the market, there was a lot around the Hong Kong Shanghai Connect that a lot of domestic investors felt would really change the market, and indeed it did in certain respects, but it was still limited. And when we look forward, we don't really see anything else that's in the near term that's going to drive markets forward. Even the Hong Kong Shenzhen Connect, maybe that may make a change in domestic markets, but we don't really think that'll affect the mainland market going forward in 2016. The BAT will continue to, quote, win in the financial industry, but mainly in payments. As we talked before, we were very bullish on these private banks at the beginning of 2015, and really it hasn't really happened for the BAT so far in 2015. So we really think that will be limited. In addition, the card regulations will certainly open up in 2016, but the progress of the foreign players is still a bit unclear. When you look at a MasterCard or a Visa or an American Express coming into the market, you have to ask the question, what is the real value add? What can they do in a country where every single debit card that's issued already has the China UnionPay logo on it? All of the credit cards that are issued domestically have at least the China UnionPay logo on it, if not China UnionPay and another brand. So what can they do? How can they change and be a value add within the market in China? In addition, we feel that even our attitude on this has changed over the past couple of weeks. We really feel that whilst regulations were supporting innovation in 2014 and 2015, we feel that in 2016 these regulations are really going to limit innovation within the financial industry in 2016. Regulators will still struggle with how to respond to a changing market. We may see a leadership change, firstly at the CSRC, and that may lead to a bigger push of this idea of there being an Uber regulator. So a regulator that's kind of above the PBOC and the CBRC and the CSRC, kind of an overall regulator, which in certain respects would be good for the market because it means the responses to a lot of these issues and challenges in the market will be more consolidated, but it may also be a challenge for the market going forward. The Fintech regulation also took us by surprise. We weren't expecting something like that, but we feel that with this regulation now in place, or with this restriction around the business regulations in place, we likely won't see that change for 2016, which could be a challenge for Fintech. The mobile payment regulation was also a bit of a surprise to us, not insofar that there was regulation around that, but the limits on the transaction limits. That was a bit of a surprise to us. So that'll be a challenge, and how the regulators address these points and continue to attempt to revive markets through the opening up will be a challenge for them going forward in 2016. So how do they continue to open up markets, but at the same time control them will be one of the biggest things to watch within 2016. So with all that being said, we wanted to present you today with a little bit of the ideas and our thinking about what we see for the outlook and trends for the financial industry in 2016. As Paul mentioned, we also have the top 10 trends reports that are coming out in 2016. So there should be more within that can help you understand a little bit more about what we're seeing in the market in more detail around banking and capital markets in the space. And so at this point, I want to hand it back to Paul for the Q&A because I've seen some questions come in the background. So maybe we can go through a little bit of those in the time that we have left.
Okay, well, thank you very much for that, Zen. And it certainly appears there's lots happening in China and Asia, and that 2016 is going to be a very interesting year for the whole financial industry and financial tech in general. So as Zenon mentioned, we have been getting some questions in while the webinar's been going on. So I'm going to get through those, and we're keeping an eye on the time, and we won't hold you back from that around the 45-minute mark here as well. So we'll get to the first one. First one, Zenon, comes from Jackie. Jackie asks, the regulators seem to be very active in limiting the financial industry. Is this a change from before, and where do you feel, he asked, where do you feel this is going?
Yeah, that's an excellent question. I think one thing that surprised us about regulation in 2015 was that there was no lack of surprises. I think, across the industry, the way that we saw regulators respond to challenges like the stock market was somewhat unpredictable. And we don't see that changing in 2016. We saw over the past couple of weeks, the peer-to-peer regulation, which was completely expected and completely warranted, but at the same time we've seen kind of this restriction on fintech and restriction on mobile payments. And I think the innovation within the market has finally caught up to regulators to the point that they need to take a step back and kind of understand what's happening and how they're going to control what's happening in the market. And I think that's the kind of almost knee-jerk reaction that we've seen from regulators so far in the end of 2015 and beginning of 2016 is this challenge of how to continue to allow reform while controlling the risk and keeping the economy on an even keel. And that's one thing that we'll see going forward in 2016. So I think, if anything, the regulator stance has essentially tightened in 2015 and 2016, and we'll expect that to continue. So I think certainly the reforms that we've seen over the past couple of years will slow as we move forward in 2016.
Okay. Next question comes from Henry, and Henry asks, why do you think Apple Pay doesn't have a chance? Is it better technology, real offline wallet, etc.? It just seems to Henry that they've got a better fit for the market. It's just a better fit. Is that right?
Yeah, that's one of the things that's really interesting, is because you look at, if we step back and we look at Apple Pay from a global perspective, it seems to have all of the correct elements in place. There's a question about NFC acceptance, but what Apple has been able to do is get all of these platforms behind it and all of these merchants behind it to accept it. Not just obviously within Apple stores, but across the US and Europe and all of the places that it's been rolled out. So it seems like a very compelling value proposition. Now, globally, Apple Pay has struggled as well. I think one of the things that I was surprised by is the uptake of Apple Pay was very slow in these other markets. And that could be potentially because a lot of these markets, like the US and the UK, aren't traditionally mobile payment focused markets. But even markets like Australia, where Tap and Go has been around for a couple of years, and Tap and Go is huge in Australia, and Apple Pay has failed to make a dent there. So I think Apple Pay is already facing those challenges in other markets, and it's even more challenge in China, where these incumbents of Alipay and WeChat Pay already have a stranglehold on the market here. And I really think that the Apple Pay, although it may be a very sexy technology and platform, they're still going to struggle in the market here just because of the incumbency of the existing players. And these players, they've shown that using QR codes meets both regulatory regulations and requirements and meets what the consumers are looking for. And that's been, a boon for them as they've moved forward. So I think Apple Pay will still struggle in 2016, and we'll see how far they get, but it'll be a challenge, certainly.
Okay. Next question. This one comes from Patrick. Patrick asks, how has the stock market slump slowed the setup of cross-border investment programs? And he asks, should we expect this to continue in the future?
Yeah, that's a good question, and it still remains to be seen. There was a lot of talk when the Hong Kong Shanghai Connect was set up both when it was first announced in kind of 2014 and launched. That's been very good for mainland markets, I think. When you look at the volumes that are going across that link, and clearly the government was using that as another way of kind of opening up the market to both foreign investors and to make it more of a on par with the other international investment markets where you wouldn't see the same restrictions in place. What that means for the Shenzhen Connect, what that means for mutual recognition, what that means for potentially bonds going across the Hong Kong-Shanghai Connect is a bit up in the air. I mean, I think the government was trying to use the Hong Kong-Shanghai Connect to really kickstart the domestic market, and it certainly had a part in the run-up of the market over the past year, but it remains to be seen if the Shenzhen-Shanghai Connect would be able to do the same thing. I think at this point the government has talked about these programs so much that it's inevitable that they'll happen at some point in 2016, but the rationale behind that and how successful they'll be is a little bit up in the air at this point still.
Okay. Next question. This one comes from Shubrendu, and Shubrendu asks, will both the BAT and smaller fintech firms export their business models and platforms to Southeast Asia and India, or will BAT only invest and buy stakes in startups while they mop up the China domestic payments business in 2016? And it says further to that, i.e. will both smaller fintech and BAT be equally aggressive in moving overseas and squeeze out Japanese and Korean investments, or will it be in sequence with BAT moving out in year 17-18?
Yeah, that's a really good question. I think what we'll likely see, I mean, the fintech in China outside of the BAT is very limited. Outside of the peer-to-peer lending platforms, which are obviously quite large and a bit of an anomaly, there's not a lot of small fintech that has really mature solutions for international problems. So we could see these peer-to-peer lending platforms expand internationally. I mean, certainly they have the capital base here in China, but I think if we look at the way that peer-to-peer lending has developed in other markets, there are some players that have managed to go cross-border, but they haven't been tremendously successful in that. So I think with peer-to-peer lending, it'll be mainly horses for courses, and we'll see a lot of these Chinese players stick to the Chinese market. I believe they will expand into other asset classes, and as we've seen from some of the big platforms today, they're already offering wealth management products and other things that don't fit in with the peer-to-peer lending spectrum in China. So that certainly will continue. But I don't think it's going to be small fintech that come to Southeast Asia and India. I think it's really going to continue to be Baidu, Alibaba, and Tencent that push into those markets. And the question of buy versus build is really interesting. I mean, the strategy that we've seen, especially there in India with Alibaba, certainly so far has been to acquire. And that could be an indication that they feel that they don't necessarily have the business model that fits for those markets, and so it's better to buy the business model rather than build it themselves. So we'll likely see that continue. But I think the worry for Southeast Asian markets and Indian markets should be more around the Baidu, Alibaba, Tencent, the BAT, rather than the small fintech players from China.
Okay, thanks very much for that, Zenon. All right, let's get to the final question. We're pretty much right on time here. So the final question comes from Ying Mao. Ying Mao asks, what do you think the chance of Alipay actually setting up their own card network is?
Yeah, that's a really good question, and it's really impossible to know exactly what Alipay is thinking unless you're in the organization. But from our perspective, it really makes a lot of sense for them. I mean, we've seen over the past couple of years, I mean, obviously from what we talked about earlier in the presentation, they dominate the digital payment space. I mean, they have a strong hold on both mobile payments and internet payments, and they're increasingly pushing offline. So when we look at the offline trend, you have the online to offline, the O2O play that they're going after, as well as the offline acquiring through using QR codes. There's no love lost between Alipay and China UnionPay. Clearly Alipay has taken a lot of payment transactions away from China UnionPay, so there's not there's not a lot of love between the two organizations. So we could completely see with kind of the war chest of post-IPO funds that Alibaba and Financial are sitting on, a push into cards. And so we actually think that it's quite likely that we'll see that in 2016, because I think people kind of underestimate this move of foreign players moving into the cards market. I mean, certainly we'll see MasterCard and Visa and American Express all push into the market as they're approved, but we also see that there is a tremendous opportunity for some of these domestic third-party players to move into the market as well. So I think we'll definitely see that over the course of 2016.
Okay, thanks very much for that as well. All right, well, unfortunately, we're being unable to get to all the questions submitted in our webinar today, but as I mentioned, we have been busy answering many of those questions in the background, and we'll get to you individually if we didn't get to your actual question as well. Now, as mentioned earlier, today's discussion was based on Capron Asia's upcoming top 10 reports detailing the trends in China's banking industry, as well as another top 10 report looking at trends in China's capital markets industry, which will be available as part of Capron Asia's subscription service or available as individual reports. If you haven't already registered for this valuable service, we'll be providing a link to do so in the email you'll shortly receive, thanking you for your attendance here at today's webinar. This email will also contain a link to the recording we've been making of today's presentation. So if there's any information you missed or you want to listen again at your own pace, you can do that. Once again, Capron Asia appreciates your time today and hopes you found the information informative and helpful. This concludes our webinar. Thank you for joining us.